Are your emotions secretly sabotaging your investment portfolio? When fear and greed take the wheel, even the smartest strategies can fall apart. In this quick dive into behavioral finance, we'll uncover why emotional decisions often lead to costly mistakes and share practical tips to keep your investments steady and your mind clear. Ready to take control and stop letting feelings kill your returns? Let's get started. Today we will talk about why emotions are killing your portfolio, behavioral finance tips. So before we start, make sure to hit the like button and subscribe to my channel. Investing can feel like a roller coaster, with exhilarating highs and gut-wrenching lows. But behind every portfolio that underperforms or tanks unexpectedly, there's often a hidden culprit: human emotions. Despite the abundance of financial knowledge and sophisticated tools, many investors find themselves making irrational decisions driven by fear, greed, and overconfidence. This emotional interference is not just a minor distraction. It can systematically erode returns and derail long-term financial goals. Understanding how emotions sabotage investment outcomes and learning behavioral finance principles can be the key to transforming your portfolio's performance. 1. The emotional roller coaster in investing. Investing is inherently psychological. The market's volatility triggers emotional responses that can cloud judgment. When markets rise, euphoria sets in, tempting investors to take excessive risks or chase hot stocks at inflated prices. Conversely, during downturns or corrections, fear and panic cause many to sell assets at the worst possible time, locking in losses. These emotional swings lead to a behavior known as market timing, which numerous studies have shown is consistently detrimental to portfolio returns. The reality is that even professional investors struggle with these emotions, but retail investors, without access to sophisticated risk management, are often more vulnerable. Understanding how these feelings manifest is the first step toward mitigating their damage. 2. Fear, the silent portfolio killer. Fear is perhaps the most potent emotion that wrecks portfolios. When markets decline, the natural human response is to protect capital by selling. However, this often results in selling low and missing out on subsequent recoveries. For example, during the 2008 financial crisis, many investors panicked and sold their holdings at the bottom of the market, only to see markets rebound strongly afterward. Fear can also cause investors to avoid markets altogether, holding cash for extended periods. While it may feel safe, cash loses purchasing power over time due to inflation, meaning fear-driven inactivity can erode wealth silently. Behavioral finance research demonstrates that fear-induced selling is one of the most common causes of long-term underperformance. 3. Greed, the dangerous double-edged sword. While fear causes premature selling, greed pushes investors to overreach. The desire for quick gains leads to chasing high-flying stocks or speculative investments without regard to valuation or risk. During market bubbles, greed blinds many to warning signs, driving asset prices to unsustainable levels. When the bubble bursts, portfolios can suffer catastrophic losses. For instance, the dot-com bubble in the early 2000s saw countless investors buy tech stocks at inflated prices, only to face devastating declines. Greed also fosters overconfidence, leading to excessive trading, higher cost, and poor timing decisions. A balanced investment approach requires controlling greed by adhering to discipline and focusing on long-term goals rather than short-term wins. 4. Overconfidence and confirmation bias, the subtle saboteurs. Beyond fear and greed, cognitive biases like overconfidence and confirmation bias can quietly sabotage portfolios. Overconfidence leads investors to overestimate their ability to predict market movements, resulting in excessive trading and risk-taking. Confirmation bias causes investors to seek out information that supports their existing beliefs, ignoring contradictory evidence. This selective thinking can prevent investors from recognizing red flags and adjusting their strategies. Behavioral finance studies show that these biases often lead to suboptimal portfolio construction and increased vulnerability during market shifts. Awareness of these tendencies, coupled with a systematic approach, can help investors counteract their effects. 5. Behavioral finance, the science of emotion in investing. Behavioral finance is a field that bridges psychology and economics to explain why investors behave irrationally and how emotions affect financial decisions. Traditional finance assumes rational actors making decisions based solely on facts and probabilities. But behavioral finance acknowledges that humans are emotional and prone to biases. By studying patterns of irrational behavior, this discipline offers insights and tools to improve investment decisions. For example, concepts like loss aversion explain why investors feel the pain of losses more acutely than the pleasure of gains, prompting poor choices. Understanding these behavioral traps is crucial for anyone who wants to improve their investment discipline and long-term outcomes. 6. Practical tips to overcome emotional investing. Controlling emotions in investing is challenging but achievable through disciplined strategies. First, establishing a clear, written investment plan aligned with your goals, risk tolerance, and timeline helps provide a roadmap during turbulent times. Second, diversification reduces the impact of any single asset's volatility, helping to curb panic selling. Third, automating investments via dollar-cost averaging minimizes the temptation to time the market and reduces emotional bias. Fourth, setting stop-loss orders or using risk management tools can limit downside exposure without the need for emotional decisions. Lastly, regular portfolio reviews, rather than daily market monitoring, can help maintain perspective and avoid impulsive reactions to short-term noise. 7. Building emotional resilience for long-term success. Ultimately, successful investing demands emotional resilience, the ability to stay calm and rational amid market chaos. This requires recognizing that volatility is normal and markets go through cycles. Educating yourself about market history and behavioral finance can help normalize fluctuations and prevent panic. Developing mindfulness and stress management techniques can also reduce the influence of emotions during decision-making. Some investors even work with financial advisors or coaches who provide an objective perspective and keep emotional impulses in check. By combining knowledge, discipline, and emotional control, investors can safeguard their portfolios from being derailed by feelings, turning volatility into opportunity instead of risk. Emotions like fear, greed, and cognitive biases are powerful forces that often undermine investment success. They lead to poor timing, impulsive decisions, and excessive risk-taking, all of which chip away at portfolio returns over time. However, by applying behavioral finance insights and adopting disciplined strategies, such as having a plan, diversifying, automating investments, and building emotional resilience, investors can mitigate these pitfalls. The key lies in recognizing that investing is not just a numbers game, but also a psychological challenge. Mastering your emotions can be the difference between portfolio destruction and long-term wealth accumulation. If you like this video and would like to see more like it, please give it the thumbs up, leave a comment, and click the button to subscribe.